Good morning. This is Barry Knapp with Ironside's Macroeconomics. It's Monday morning, December 16th at 7 a.m. Mountain Time. Back in Colorado after a week in New York with a quick trip to Boston for a group lunch and some of the most torrential rain I've ever seen. Apparently it flooded one of the big dig tunnels, though after I got back to Logan and somehow managed to make my way back to New York. Enough about that. We took a break this week from our 3 annual Outlook notes that we wrote. We obviously published our 2025 Outlook. This week we're going to spend on our annual thematic note where we come up with 4 or 5 themes that we expect to persist through the business cycle, through the balance of the decade, longer term perspective on things. It's always a fun note for us to write. We'll begin by reviewing the ones we've written in the past and thinking about those broad themes, and we'll get that note out on Saturday morning, and then we'll wrap up with a year in review note during Christmas week, and then get back to our regular schedule after that. The note that we did write this week was titled "The Trump Treasuries Trade." We integrated observations from our client meetings last week into the note, as well as providing perspective on last week's inflation data. We also got some very interesting wage data out of the Atlanta Fed, which allowed us to think a little bit more about the labor market. We think this is a very underappreciated aspect of the economy. We hear a consistent narrative that demand for labor is strong because of the headline payroll numbers. And we just think that couldn't be further from the truth. In fact, the demand for labor was weak, and last week's Atlanta Fed wage numbers really did confirm that. And this brings us to the Fed meeting this week and our case for why they should be cutting and why they should be cutting again in January. Even this morning on CNBC, we heard the narrative that, they probably shouldn't cut, or it's going to be a hawkish cut, that sort of thing. And we just think people who are making that observation are looking at the data superficially, including a former, Fed vice chair in one of the last interviews this morning on CNBC, who thinks the data is strong. And we obviously strongly disagree. So that we wrapped up the note after that. So moving through, our observations with clients, we would say, in general, most clients do not expect the Trump economic team, to be able to make the Tax Cuts and Jobs Act provisions permanent. They think a 4-year extension of some of these provisions, like accelerated depreciation, the individual tax rate cut, all that sort of stuff, is the most likely outcome. They were very skeptical that they'll actually be able to make budget cuts sufficient to fund making it permanent, and very much viewed Washington as business as usual, even given the unique nature of this presidency, which this is going to be the first second-term president with control over both houses of Congress, albeit a narrow one in the House, since FDR. That's a very different dynamic. We get a president who knows his way around DC a little bit, with control over both branches of Congress, and we think that's an underappreciated fact. We're a little more optimistic on them being able to get the budget cut back to 20%, towards 20% of GDP, Besant's first era, than our client base, for sure. Others were worried about budget cuts slowing growth and that having an impact on equity prices and equity earnings. Obviously, for us, the mix is more important, and we don't think this will be a problem for earnings at all. In fact, we think it's necessary that we get budget cuts to stabilize earnings, because we need private sector capex to pick up. We need less government spending, and more private sector investment in order to achieve those pretty lofty earnings goals for next year. And on balance, our sense was that the trading community, fixed income community in particular, is putting that Trump trade right back on, which is the idea that we get a bear steepening of the Treasury curve. We get a sell-off in the back end, and that is what we got last week. We did finally get a disinversion of the 3-month, 10-year banking proxy curve, but we kind of got it the wrong way. We got it because back end rates went up. 10 and 30-year swap spreads, moved back towards their lows in a somewhat supply-driven sell-off. Now, the 3-year and 10-year auctions went fine. The 30-year auction was pretty sloppy, and that's just indicative of market participants thinking that they're not going to, they, meaning the Trump administration is not, and Trump team and Republican-held Congress are not going to be able to cut spending, and that supply is going to continue to be a problem in the fixed income market. And that remains, for us, the biggest risk to the equity market rally is a real bear steepening sell-off in Treasuries. 10-year tips are back above 2%. The 10-year nominal rate is back above that key 430 technical level, and a significant move higher in rates would clearly stall the equity market out. And in fact, last week's price action was back to tech going up, semis going up, and everything else struggling, which is what we had when during the course of this year when the Treasury market came under pressure. So moving on to inflation week, the bottom line here is that goods price deflation is dissipating. Goods prices are coming up, though we're not too concerned about that in the long run, but rents are cooling. And rents cooling is probably the most important component. This inflation's sticky. That's been our thesis all along. It's sticky but stable, and we don't think the Fed should be pushing too hard from 2.75%, let's say, on core PCED to try and get it to 2. We think that would be just as big a mistake as the mistakes they made in the 2010s when it was running at 1.5 and they were pushing to get it up, and that caused capital misallocation. In this case, it will put undue amounts of pressure on small banks, small businesses, and ultimately the labor market. But as I said, goods prices have gone from, on a 3-month annualized basis, just looking at my notes here, they were running at negative 2.4% in August, and they're now at plus 2.1%. So we've had a real firming of goods prices. Now, the trade-weighted dollar has rallied 5% since September. So for us, it's unlikely that goods prices will continue to rise. That deflationary impulse from China persists. Their manufacturing PPI is still running at negative 2.6 or so. So there may be a little bit of firming of goods prices here, some pull forward of orders in front of anticipated tariffs, but ultimately we do not believe that goods price inflation is going to be a persistent problem for us in 2025. But from a policy perspective, rents starting to cool, and that rent of shelter measure dropped from 0.39 in October to 0.30 in September. That's closer to the 0.25 trend it was at pre-pandemic. We think if rents do get back to pre-pandemic trends, it won't persist because of the damage the Fed did to the supply side of the housing market. However, from the Fed's perspective, they are fully expecting new tenant rents, which are running at 1%, to pass through to this number. So this will, last week's number undoubtedly will confirm their Bayesian prior and make them more inclined to think that inflation is still headed lower. So net, I think the way the Fed's probably looking at the numbers last week is more favorable than some of the chatter we heard on the networks. So moving on to the wage tracker number, that's one that doesn't get a lot of press. It doesn't show up on your Bloomberg ECO function, but it's a very good wage series. And the headline number, and keep in mind this is a 3-month moving average, dropped from 4.6% in October to 4.3% in November. For the lower income part of the strata here really is under pressure. The paid hourly series dropped from 4.3 to 4.0. We then like to look at what we call a wage differential. That's the differential between the lowest quartile of wages and the highest quartile of wages. That fell to negative 0.3%. That's its weakest reading since January of 2014, when the labor market was still struggling with deleveraging the household financial sector following the global financial crisis. And the switchers stayers spread printed negative 0.1% for the second consecutive month. That only goes negative during recessions. So again, that shows demand for labor is actually quite weak, which is consistent with the household survey. And our broad observations is that demand for labor has weakened quite a bit. Then we went on in the note to talk about the effect of immigration and how much it slowed. There was a very interesting New York Times article stating that the percent of foreign born individuals in this country at 15.2% is the highest ever, surpassing 1890 when it was 14.8%. And the surge we had in immigration from 21 through early 24 was the largest ever, surpassing the late 1800s and early 1900s. That's obviously slowed and reversed, and the impact on the labor market and inflation is going to be a big point of controversy and discussion, pardon me, as we get into 2025. So moving on, our basic thesis here is that the Fed does need to cut. They need to get to at least 4%. They probably need to cut all the way to 3.25%, which is our forecast for next year. They need to do that to sustainably disinvert the curve, reopen the small bank credit channel, and improve small business demand for labor. We realize that's not consistent with the common narrative, but when we look into numbers, we look at the household survey, we look at this wage data, we see weak demand for labor, and we think that's the most underappreciated economic story today is that the labor market is much weaker than those headline establishment numbers would lead you to believe for reasons that we've been speaking about, writing about for 9 months or more. So the summary of economic projections forecast is likely to show a little bit firmer inflation, at least one fewer rate cuts in 2025, but we do ultimately think they will end up cutting another 100 basis points in 2025. So wrapping this all up, as I said, the bear steepening remains the biggest risk to the markets right now. We are more optimistic than market participants on the budget and the ability for the Trump team and Republican Congress to stabilize the trajectory of the debt to get us back to a primary surplus. Besant's first arrow, which is a 3% budget deficit, which would be a primary surplus, given that interest payments are 4% of GDP right now. So we think that they can get there, but it is going to be a struggle next year. The sequencing matters. And, quite a few customers are expecting an equity market pullback early in the year, maybe as soon as Inauguration Day. Certainly a possibility. And if the rates market continues to push higher in terms of rates and real rates in particular, that's a real possibility. We would likely find ourselves as a buyer of that weakness, but we'll see how that progresses. One final note, the Fed did release the flow of funds quarterly data last week. We put a chart in the weekly. It shows government debt rising and every other sector falling. Household debt to GDP rate, the ratio is falling. Non-financial corporate sector debt to GDP rate is falling. And it's just the government piling on the debt right now. We can finance that debt, but that debt will crowd out private sector investment, so it does need to be brought under control. That's it for me this week. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.